In the study of the financial markets, the most dangerous assumptions are those that seem, on the surface, to be the most logical. To the average observer, a stock advancing on high volume is a clear sign of strength, while a stock declining on high volume is a sign of weakness. This simple interpretation forms the basis of most conventional analysis. Yet, it is this very surface-level reading of the tape that lays the most effective traps for the unwary trader. William Delbert Gann, a man who dedicated his life to uncovering the scientific laws of the market, taught a more profound and often contradictory truth. He wrote in Truth of the Stock Tape, "Often when stocks look the weakest on the tape, they are the strongest as accumulation is taking place. At other times, when they are booming and very active and appear the strongest, they are really the weakest, because the insiders are selling. This is the great paradox of the market and the essence of its deception. Volume does not always mean what it appears to mean." This video is a deep dive into the methods of William Delbert Gann for looking beyond the obvious, for understanding when the volume is telling the truth and when it is telling a calculated lie. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To correctly interpret the message of the tape, one must first understand the fundamental role that volume plays in any market movement. William Delbert Gann employed a simple but powerful metaphor to explain this relationship. Volume is the engine of the market. He stated, "The volume of sales to the stock market is the same as the steam is to the locomotive or the gasoline is to the automobile. The sales are the motive power which drives prices up or down." This concept is not abstract. It is a mechanical and practical law. A price movement, no matter how dramatic it appears, is unsustainable if it is not supported by a corresponding amount of motive force. A stock cannot begin a great and sustained advance without a significant volume of shares being purchased. Likewise, a major decline cannot occur without a significant volume of shares being sold. The volume of sales is the direct measure of the energy, the force, and the conviction behind any move. This understanding of volume as the market's fuel leads to a critical insight. The volume of sales is the primary indicator of the activity of large, informed interests. The small public trader does not have the capital to create the massive volume spikes seen at major turning points. When the volume of sales on a stock swells to many times its normal average, it is a clear signal that the professionals, the insiders whom William Delbert Gann personified as the composite man, are at work. They cannot accumulate the vast line of stock required to initiate a bull campaign, nor can they distribute their holdings to the public at the top without leaving their footprints on the tape. These footprints are volume. Therefore, a study of volume is not just a study of market activity. It is a study of the intentions of the market's most powerful players. A period of abnormally high volume is a signal to the astute trader that a major battle is taking place and that a significant transfer of ownership is underway. A period of extreme dullness and low volume is an equally important signal that the professionals have withdrawn, having either completed their work or being content to wait for a more opportune time to act. The master key to unlocking the true meaning of volume and the central principle that separates the professional tape reader from the amateur is the methodical comparison of the volume of trading to the resulting price movement. William Delbert Gann did not believe in complex indicators. His method was a direct and logical analysis of the facts as they were recorded on the tape. He would ask two simple questions. How much force was applied? And what was the result of that force? The answer to these questions, whether they showed a relationship of harmony or discord, would reveal the market's true position. First, let us examine the state of harmony, which is when the volume tells the truth. A healthy, sustainable market trend is characterized by a harmonious relationship between the volume of sales and the movement in price. In a legitimate bull market, advances should occur on expanding volume. As the price pushes to new highs, the increasing volume demonstrates that the demand is robust and aggressive, easily absorbing any profit-taking. On the subsequent normal reactions and pullbacks, the volume must noticeably contract. This shows that the selling pressure is not serious or sustained. The lack of significant volume on the decline proves that the selling is not coming from informed interests, but is merely the light profit-taking of weaker hands. This rhythmic expansion and contraction of volume in sync with the price swings is the signature of a healthy trend. Likewise, a valid breakout from a long period of consolidation must be accompanied by a decisive surge in volume. The breakout is a significant event, and it requires a significant amount of motive power to be considered genuine. In all these cases, the volume's message is clear and honest. It confirms the story that the price is telling. The real secrets to spotting market deception, however, are found in the state of disharmony. Disharmony occurs when the relationship between volume and price becomes illogical or disproportionate. This is when volume lies to the untrained eye, creating an illusion that is the opposite of the market's true intent. William Delbert Gann identified two primary forms of this deceptive disharmony. The first and most powerful signal of a reversal is great volume without a corresponding progress in price. This is the ultimate sign of a trend reaching its point of exhaustion. William Delbert Gann explained this with a clear, practical example in Truth of the Stock tape. Suppose U.S. steel has advanced 20 or 30 points, and it reaches a level where there are 200,000 shares in one day, but the stock only gains 1 point. The next day, there are 200,000 shares, and it makes no gain. This is plain enough that at this point, the supply of stock exceeds the demand, or at least that buyers are able to get all the stock they want without bidding prices up. This is the signature of distribution at a top, or absorption at a bottom. The immense volume is the clear evidence of a titanic battle between buyers and sellers. The fact that the price makes no progress is the verdict of that battle. The opposing force is equal to or greater than the trending force. At a market top, it shows that the enthusiastic public buying is being met and fully absorbed by the massive and previously hidden selling of the insiders. To the public, the high volume looks like excitement and strength. To the professional, it is an undeniable sign that supply is overwhelming demand and that the advance is over. The second form of deceptive disharmony is the inverse, a significant price movement without the support of volume. This is the classic signature of a false move, designed to trap the unwary. Imagine a stock has been trading in a narrow range for several weeks, with a clear resistance level at its top. One day it pushes through that resistance and makes a new high for the move. The breakout traders, acting on the price signal alone, rush to buy. But the professional analyst immediately checks the volume. If the breakout occurred on conspicuously light or even below average volume, it is a lie. The price move lacks motive power. It shows that there is no genuine aggressive demand from informed interest behind the move. Such breakouts are often manipulative upthrusts, engineered to trigger the stop-loss orders of short sellers and to lure in breakout buyers. Because they lack the fuel of real buying power, they cannot be sustained. They are almost invariably followed by a swift failure, with the price falling back into its old trading range. The price action lied about the beginning of a new trend. The lack of volume told the truth about its weakness. By mastering this fundamental principle of comparing the volume to the price action it produces, the trader learns to see through the market's most common deceptions and to align his actions with the true underlying balance of power. Having established the foundational law of William Delbert Gann's volume analysis, the methodical comparison of the volume of sales to the gain or loss in price, we now move from the theoretical to the practical. It is at the great turning points of the market where this principle yields its greatest rewards. The market top is a period of maximum deception, where the prevailing emotions of greed and euphoria create a powerful illusion of strength. The amateur trader, seeing high volume and volatile price action, is lured into buying at the highest levels, becoming the final holder of stock that the informed professional is eager to sell. But for the analyst who has learned to read the tape through the lens of William Delbert Gann, these very signals of apparent strength are, in fact, the clearest and most undeniable signs of weakness and distribution. We will now dissect the specific volume signatures that William Delbert Gann identified as the hallmarks of a market top, revealing his methods for spotting the end of a bull market long before the devastating decline begins. William Delbert Gann divided the market's life cycle into 7 zones: a normal zone, 3 zones above normal, and 3 zones below. The final stage of a great bull market he called the 3rd zone, or highest above normal. His description of this phase is a perfect portrait of a market top. He wrote that this zone marks a period of distribution characterized by great activity and extremely wide fluctuations. This is the time when the public buy madly. Reports of big earnings come in. Dividends are increased and stock dividends declared. Everything is optimistic. This combination of extreme volume and chaotic price action is the first great warning sign that a top is being formed. The high volume, which the public mistakes for broad-based buying and strength, is in reality the sound of a massive transfer of ownership. It is the noise of the insiders or large operators methodically feeding their vast holdings, accumulated at much lower prices, into the hands of an ecstatic and undiscerning public. The wide, feverish fluctuations are the evidence of this struggle. The price may surge to a new high in the morning on a wave of public buying, only to be beaten back down in the afternoon by a wall of professional selling. It rallies again and is sold into again. This is a clear example of large volume without sustained upward progress. While the price may be volatile, it makes little net headway. It is churning. William Delbert Gann explained that when the first sign of the end is near, stocks will open up anywhere from 1 to 5 points higher and keep on going, up without much reaction for a time. But as distribution nears completion, this changes. After such a period, he warns, traders, come down next morning and find stocks opening off anywhere from 2 to 5 points. There may be no news out or any reason at all for the decline. But the real cause of it is that the market has reached the stage where supply exceeds demand. The high volume, which once propelled the price upward, is now only sufficient to hold the price in a volatile range. This is the first great lie that volume tells at the top, the lie of strength. The professional analyst, however, sees the truth, that the motive power is now being used not to create a new advance, but to facilitate a massive distribution campaign. Not all distribution occurs amidst the wild, wide swings of a final market peak. A more subtle and equally deceptive form of distribution happens when a stock, after a significant advance, halts and begins to trade in a narrow range on abnormally high volume. This is a prolonged period of churning, where the stock makes little to no upward progress for weeks or even months, despite a massive turnover of shares. William Delbert Gann provided a classic example of this in his analysis of Baldwin Locomotive at its 1919 to 1920 top. He noted that sales ran from 300,000 to 500,000 shares per week, while the stock was fluctuating between 130 and 156. This was when distribution was taking place. To understand the significance of this, one must consider that the total outstanding stock of Baldwin was only 200,000 shares. This meant that the entire capital stock of the company was changing hands more than twice each week, yet the price was trapped in a range. This is another perfect illustration of the Gann principle of comparing volume to price movement. The motive power being applied to the stock was enormous, but it was producing no forward motion. It was like a powerful engine spinning its wheels, generating a great deal of smoke and noise, but going nowhere. This action showed with plain indication that the selling was greater than the buying. Every time the stock attempted to rally within its range, it was met with a sufficient supply of stock from the insiders to stop the advance. The public, seeing the high volume and the stock's refusal to decline, felt safe and continued to buy, believing the stock was simply consolidating before its next great move upward. In reality, they were absorbing the massive line of stock that the professionals were methodically unloading. William Delbert Gann taught that when you witness a volume of sales that is many times the floating supply of a stock, yet the price is unable to make new highs, it is an unmistakable sign that distribution is underway and that a major decline is being prepared. The final act of distribution is often the most deceptive. It is a false move into new territory, a breakout to a new high that is specifically engineered to trap the last of the bulls and to convince the public that the trend is stronger than ever. William Delbert Gann provides a masterclass in identifying this maneuver in his analysis of U.S. rubber from 1919 to 1920 in Truth of the Stock tape. After a long advance, the stock made a high of 138 in June and August of 1919. It then consolidated for several months. In January 1920, the stock was finally rushed up to a new high of 143 in January 1920 and quickly broke back. This new high, 5 points above the previous peak, would ordinarily be an indication that it was going higher. This is the trap. The breakout traders and the public, seeing the new high, rushed in to buy. However, the professional analyst following the rules of William Delbert Gann would have seen the lie. The key was the immediacy and the character of the reversal. Gann noted that within a few days the stock had declined sharply back to 136. This rapid failure showed that heavy selling had been encountered, that the new high level was made at the expense of shorts and outside buying, that the selling which started in June 1919 was still there and that someone was supplying the stock. The breakout was not a sign of new dominant demand. It was a final manipulative exhaustion of the remaining buying power. The subsequent rapid decline followed in February 1920, and when the stock broke below 112, which was under the last support point, it was a signal that distribution had been completed. The new high was a lie. The speed of the rejection and the subsequent break of key support levels told the truth. By analyzing not just the breakout itself, but the volume and the velocity of the price action immediately following it, the Gann analyst can distinguish between a genuine continuation and a final deceptive trap. To truly master the art of reading these confirmation signals at critical market junctures, to interpret the subtle interplay of price and volume that confirms whether a level will hold or break, one must go to the source. The rules and principles we are discussing are but an introduction to the deep and practical science laid out by William Delbert Gann in his foundational masterpiece, Truth of the Stock Tape. This isn't just a book. It's a complete course in reading the tape as he did, to understand the story it tells about the constant battle between buyers and sellers, between the informed insiders and the hopeful public. It is the definitive guide to judging the position of stocks, identifying accumulation and distribution, and determining the main trend by analyzing the force behind the moves. In preparing this analysis for you, we have gone to great lengths to uncover the original materials. We were able to locate in archives over a century old the very charts that William Delbert Gann himself included in the first edition of Truth of the Stock Tape. We must be honest about their condition. Not all have survived the passage of time in perfect form. Some are remarkably clear, while others are more difficult to read. We ask that you do not judge them too harshly for their appearance. What could be done to preserve them has been done. Their value is not in their visual perfection, but in their immense historical and educational worth. They are a direct window into the mind of a master, showing you exactly what he was looking at when he formulated his timeless rules. The true value lies in the material itself. For any serious student who wishes to move beyond simply drawing lines and truly learn to read the market's intent, this book is indispensable. Get your copy of this invaluable resource through the link in the description below. Just as the informed operator uses the public's greed to distribute his shares amidst the illusion of strength at a market top, he uses their fear and despair to accumulate his line of stock at the bottom. The market low is a period of maximum pessimism, a time when the financial landscape appears its bleakest. It is here that volume tells its most deceptive and powerful lies. To the untrained eye, The dramatic price declines and bursts of activity at the bottom are seen as the final confirmation of a catastrophic breakdown, a signal to sell everything at any price. But to the professional analyst who follows the methods of William Delbert Gann, these very signals of apparent chaos and weakness are, in fact, the clearest signs that a major manipulative campaign is reaching its conclusion and that a new bull market is being born from the ashes of the old. We will now explore the inverse of our previous analysis, dissecting the volume signatures that expose the deception at the bottom and reveal the methodical process of accumulation. The most spectacular and often most profitable sign of a major market bottom is what William Delbert Gann described as the final culmination of a panic. This event is the mirror image of the feverish activity at the top, but it is driven by the raw emotion of fear instead of greed. He described this period, his third and final zone below normal, as one of panicky conditions, extreme pessimism. Investors lose confidence and start selling out. After a long and punishing decline, the last remaining weak holders are finally forced to capitulate. Margin calls cascade through the system, forcing the liquidation of accounts, and a final terrifying wave of selling hits the market as the public abandons all hope. On a chart, this event is unmistakable. It is characterized by a day or a week of an exceptionally wide price range, a sharp, violent plunge to a new low, and a massive climactic spike in the volume of sales. To the amateur, this looks like the abyss. The huge volume seems to be the final nail in the coffin, confirming that the selling pressure is overwhelming and that the stock is headed for zero. But this is the lie. The Gann analyst, applying his core principle of comparing the volume of sales to the gain or loss in price, sees the truth. He understands that for every share being sold in a panic, there must be a buyer on the other side, calmly absorbing it. This enormous volume is not just the sound of capitulation, it is the sound of absorption. It is the evidence of a massive transfer of shares from the weakest, most terrified hands into the strongest, most well-capitalized hands of the insiders. William Delbert Gann provided a perfect historical example of this phenomenon in his analysis of the 1920 bear market bottom. He wrote in Truth of the Stock Tape, on December 22, 1920, stocks declined rapidly and the volume of sales reached 3 million, which was the largest day of the year. This was the final culmination from which a big rally started. Why was this a bottom and not a continuation? Because this immense volume, this colossal motive power, failed to produce a sustained further collapse. The selling pressure, as tremendous as it was fully met and absorbed by an even greater and previously hidden buying power. This is the ultimate sign that the balance of power has shifted. When you witness a day of panic selling on the largest volume seen in months or even years, and the price either stops declining or closes well off its lows, you are not witnessing weakness. You are witnessing the final aggressive act of accumulation by the very interests who intend to lead the next bull market. Not all bear markets end in a fiery panic. Some simply wither away. This brings us to the second, more subtle volume signature of a major bottom. A period of narrow fluctuations and dullness after a long decline. After months of falling prices and high anxiety, the market enters a state of deep apathy. The public has either sold out or is so discouraged that they have stopped paying attention. The news is universally bad. The price of the stock drifts aimlessly in a narrow range near its lows, and the volume of sales dwindles to almost nothing. To the remaining market participants, this lifelessness appears to be the ultimate confirmation of weakness. The stock looks abandoned, forgotten, and without any hope of recovery. But this, again, is a deceptive lie. William Delbert Gann taught that this period of extreme dullness is one of the most bullish signs a trader can see. He wrote, "When a stock or group of stocks on averages remains for a long time in a narrow range and the volume of sales is small, it is a sign that accumulation has run its course and the market is getting ready to turn." The logic is impeccable. The near-zero volume is the market's own testimony that the selling pressure has been completely exhausted. Everyone who was forced to sell through margin calls is gone. Everyone who was scared enough to sell has already done so. The stock is now held only by the long-term investors and the strong-handed insiders who were accumulating during the decline. There is simply no significant supply of stock left to be sold at these low prices. The motive power for the decline has run out of fuel. The market is now in a state of perfect equilibrium, a vacuum where even the slightest return of buying interest can have a disproportionately large effect on the price. With no overhead supply to overcome, a small amount of demand can ignite a sharp and sudden rally. While the panic bottom is loud and violent, the dull, lifeless bottom is quiet and stealthy. It is a lie of omission. The lack of volume lies about the stock's potential by concealing the fact that the sellers have completely disappeared from the market. Whether a bottom is formed by a violent panic or a quiet period of dullness, the professional trader often waits for one final piece of confirming evidence before fully committing his capital. This is the test of the old low. After the initial low is established and a first preliminary rally occurs, the market will almost invariably drift back down to re-examine the area of the previous bottom. The action of both price and volume during this test provides the final crucial clue as to whether the bottom is real. Here again, the principle of comparing volume to price movement is paramount, and successful or bullish test of an old low must occur on significantly less volume than the volume that formed the initial low. This is the definitive proof that the selling pressure has dissipated. If the first low was formed on a panic volume of, for example, 3 million shares, and the secondary test occurs on a volume of less than 1 million shares, it is a powerful confirmation that the liquidation has run its course. The sellers made their great push on the first decline. On the second attempt, they had no force left. This is the market's way of telling the truth after a period of deception. The initial panic and high volume created the illusion of unending collapse. The subsequent low volume test reveals the truth. The sellers are gone. This formation of a double bottom, especially when the second low holds at or slightly above the first, is an exceptionally high probability buy setup. It combines the evidence of a price level holding with the evidence of selling exhaustion from the volume. It is a signal to act with confidence, placing a protective stop-loss order just below the extreme low, knowing that the market has provided strong factual evidence that a new uptrend is beginning. Volume in the hands of an untrained observer is a tool of deception. It can scream strength at a market top and whisper weakness at a market bottom, leading the emotional trader to consistently buy high and sell low. But volume does not truly lie. It tells the factual story of every transaction, of every battle between supply and demand. The lie is not in the data, but in its simplistic, isolated interpretation. For the professional who analyzes the market through the lens of William Delbert Gann's fundamental principles, volume becomes the most honest indicator of all. By meticulously comparing the volume of sales to the price movement it produces, the analyst learns to read the true story of the tape. He learns to see past the market's most clever deceptions and to understand the real intentions of the informed professional operators. He understands that a massive volume that fails to advance the price is not strength, but distribution. He knows that a panic-stricken plunge on enormous volume is not a signal of further collapse, but of absorption. And he recognizes that a market drifting lifelessly on no volume is not dead, but is gathering its strength. This is the art of reading the tape as he did. It is the key to avoiding market traps and the foundation for trading in harmony with the smart money.